Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Now, last week, market regulator SEBI ushered in some major changes. Some may even call them major reforms in the mutual fund sector. While SEBI has reduced total expense ratios or TERs on one hand, it has also, more importantly perhaps, overhauled the manner in which mutual fund houses pay commissions to distributors. What has happened is that all upfront payment of incentives, largely all upfront payment, has been banned. This means that the distributor will no longer get paid the moment you write a check to invest in a mutual fund scheme, which perhaps in turn means that that his interest is now no longer in getting investors like you and me to perhaps more frequently change our mutual fund investments and our holdings. So churn rates might go down. That seems to be the first impression. So what lies ahead for both investors as well as for the mutual fund industry itself? Well, I have a panel of experts with me joining in to discuss this over the next half an hour. Joining us today is Ashish Somaya, CEO of Motilal Oswal AMC. We have A. Balasubramanian, CEO of Aditya Birla Sun Life Mutual Fund, Feroz Aziz, Deputy CEO of Anand Rathi Private Wealth Management, and Nimisha, CEO of SBI Wealth Management. Gentlemen, thank you so much for joining in. This is, I believe, a big turning point. It's a big moment for the mutual fund industry as a whole. The talk of the reduction in expense ratios, this has been on for a while, but a simultaneous change in the manner of payout of commissions. So I want to get first thoughts from the panel on this. So Ashish, why don't you start off? Initial thoughts on what was announced last week.
I think at the outset, fabulous for investors, because by various estimates, one can imagine that anywhere between 20 to 30 basis points, or at least 15 to 30 basis points kinds of savings for equity funds would be passed on to investors. So no doubt about that at all. As far as the working of the industry is concerned, in terms of selling patterns, in terms of how do we make our funds available to end investors, and how a highly regulated, well-established product kind of continues to penetrate, I think on that front we will need to realign quite a few things and we might face some challenges. But first up, I can say it's fantastic for investors because straight away adds to their returns.
Okay. All right. Let's get in the other mutual fund view as well. We have Bala with us on the panel. So, Bala, my same question goes to you. Your initial thoughts, and I know it's early days, but how exactly do you think will these regulations be rolled out? How will this whole trail commission model really work?
Yeah, I think the new regulation, there's absolutely no doubt, it benefits the as it exists in any other industries. It benefits the investors. In our case, the mutual investors will benefit out of the proposed reduction in the expenses. There is absolutely no doubt on that. Also, one has to remember the fact that India is still underpenetrated in terms of expansion, getting more and more customer base. Therefore, the hard work which both mutual fund players and the distribution community have to undertake in order to build a size have to remain the same. At the same time, the cost factor for each of us have to be relooked at, given the fact that it's going to have a revenue impact both for the AMC as well as for the distributors. Therefore, the only way actually to look at the business model is to actually look at where all the cost structure can be cut, where all the automation can help us actually in building the cost structure come down. At the same time, optimize my revenue. And having now dropped the upfront commission, there is absolutely no doubt that it impacts the sales for the first year. At the same time, the trail commission which comes over a period of time, as the market keeps going up and as the portfolio value keeps rising, one should remember the fact that the trail commission also increases the revenue potential for both the AMCs as well as the distributors. Therefore, one has to really look at the whole business model in terms of how each one of us have to adjust, given the fact that the decisions will be coming in soon from point of view of implementation. I have seen in my own lifetime in the 25 years of mutual industry, and every 5-6 years the business model keeps undergoing a change. One has to of course keep adjusting to the emerging trend through the regulations as well as many other aspects.
Absolutely. Perhaps it is sort of the time, I guess, Ashish, that people do go back to the drawing board and see how the whole model is going to work out, as Bala was mentioning. Same question to you. Help us understand. We'll come to expense ratios in a bit. Sure. But first, as an investor, I need to understand now how the commission model is going to work. So just explain your understanding of trail. At what point will commissions be paid, and what an investor needs to be aware of?
See, I think, like you said in the introduction, in the past, commission used to be paid in two formats. And it could have two components basically. One component was that when the investment is made, at the end of the very same month, there is a certain fraction of the investment which is paid as commission, which is called upfront, because it's on immediate basis. And then there is a second element which is called the trail commission, which means that it is paid through the life of the asset.
Okay.
So as long as your investment is in force with the asset manager, all through that period, a certain fraction is paid, and that's called trail commission.
And typically, is that on a sort of half-yearly basis, annual basis? How frequently are the incentives
paid? It's paid every month. So I'll give you an example. Let us say if the trail commission, let us say is 0.6%, okay, 60 basis points. So it is 0.6% annual, which means it is 0.05% per month. So the mechanism of payment is that for the month, the average assets are calculated and then multiplied by 0.05%, which would annual out to 0.6%. So it's basically calculated for annual average assets, settled every month in fractions. So that's trail commission. And the other one, upfront, means obviously the month where it is invested, immediately something. Now, somewhere there is this belief that instant gratification is what appeals to human beings. So there is a belief that if you pay upfront commission, the higher the upfront commission, it is feared that that might act as an influencer for where the investment could be directed. Because if X pays more upfront and Y pays less upfront or no upfront, then it is perceived that X is a more attractive proposition from the intermediaries.
From the distributor's point of view.
May not be 100% true, I'm saying perception. So now the move is that you kill that whole fear and say that, okay, no upfronts can be paid. So for the intermediary, there is no instant gratification. And in some sense, one can also say that there is an alignment of interest for the asset manager, for the intermediary, and for the investor. Because if the asset manager performs and provides good service, that's when everybody wants to stay invested.
Oh, absolutely.
Yeah, but if you pay upfront commission, then the investor is in the fund. The asset manager yet has to perform, but the intermediary got his share of earning right at the start itself. So these are the certain...
And therefore the propensity, or I mean, what is always said, the propensity to lead investors to churn more. Because the more checks people are writing, the more commissions that you're earning.
It can be. So there are, see, within intermediaries, there can be very good high quality intermediaries, and on the margins there could be some who are influenced by these practices. But so to remove any such doubt, what has been done is that now as an asset manager, you just can't pay any upfront. All commissions have to be necessarily trail, which means that it is aligned. Till the time I perform, the investor stays and the investor is being serviced, and only till then the commission is paid.
Absolutely. Well, I just want to tell our viewers that it's not just the manner in which commissions are paid, it's not just that is changing. There's another important rule that SEBI has put out, that now all expenses, all incentives have to be paid out of the expense ratio itself. There can be no added incentives from the mutual fund's own kitty, from its own balance sheet, or from its own pocket. So there can be no added ways of influencing, if I could say, the distributor community. So let's get the wealth manager's perspective on this as well. Let me start with you, Feroz. So these are seminal changes. How do you think they are going to be taken by the distributor community, first of all?
See, I think it's a very good move, like, of course, it's been said. So first is to quantify what that is. If you're looking at equity, it's a 10-year investment. If it's a 10-year investment, there are 3 reductions in it. One is, of course, the TER. The second is the B30 commission, which was an average of 17 paisa, that is 0.17%, should ideally come down to 3 to 4 paisa.
So let's just demystify that for our viewers. B30 being the expenses that a mutual fund could charge for going forward and penetrating into smaller cities and towns, right? Beyond the metro cities.
Correct.
So those were the additional expenses.
Correct. So the fund was allowed to charge an expense. So that was almost about 17 paisa. That comes down to 4 paisa. So there's a reduction, straight reduction in TR. There's a reduction here of 15 odd paisa or 13 odd paisa. Then the GST on a portion of it also reduces, because if you're charging less, then there's a lesser GST being charged. So there's an absolute impact of 40 to 45 paisa in certain schemes envisaged. Now translating this looks very tiny, but the attractiveness of this is enormous. Now, for example, if I have a 10 lakh rupee investment for 10 years, now I'm going to get 1.6 to 1.7 lakhs more in a 10-year period. So this is a gift of almost a 1-year return to the investor. So you have to quantify that. So that's a very large quantum. Second is, there was, having said which, there is a lot of malpractice which was going on. Being mutual fund being the most regulated platform for a person to participate in good assets, there was still a lot of malpractice which was happening. I think that's going to be curbed dramatically with this upfront going away. Any distributor who has the long-term business model in mind would not actually be perturbed. For example, Anand Rathi decided to go all trail 3 years back.
Yes.
Right? So that's good. And I think it'll be a more cleaner business. Third point is, when you're doing stuff like this, what's going to happen is penetration is going to become far more simpler.
Sure.
But one word of caution is, in times like these, advisors start giving advice on other platforms like AIFs and PMSs, which actually motivate them on a larger upfront commission. Ideally, SEBI should bring all the products which can be infused in a portfolio on the same platform, right? Otherwise, like a PMS, assets have become 10 times in the last 5 years.
And I was just wondering, so how much higher are commissions typically paid out for PMS schemes? Because for larger ticket investors, I'm guessing that might be advice coming in that instead of mutual funds, why don't you experiment with a PMS?
See, their upfront commissions are not regulated, unfortunately. So I've been offered as a wealth management advisor a 4-5% commission upfront. Of course, that gets normalized over a period, but that's the kind of commission which is not an abnormal commission. So that's very, very largely motivating for a person to change his business model, which I think should be restricted.
Absolutely. Nimish, so these are sort of, sands are really shifting for distributors and the manufacturers. Your thoughts on the manner in which this will roll out?
So I think, if you divide the issue into two things, one is in terms of capping the TER, and second is in terms of the upfront commission. So if you look at the TERs, definitely like, what has been said, pro-investor move by SIB, wonderful. And as far as upfront commission is concerned, I think it will bring in a level playing field amongst all distributors. Till now, it all depended on how your business model is. So for example, at SBI, when we started in January 2016, a decision was taken that we are going to kind of, have 100% trail commission model. So a lot of the platforms are already shifting to 100% trail commission model in anticipation of what the investors want. So I don't think there is much of a issue as far as upfronting versus trail commission is concerned, because that is again pro-investor. So we feel that this is definitely going to be proactive, but the cost aspect, I think the cost of acquiring a client is now suddenly increasing, and it will definitely hit the smaller distributors more than the larger ones.
Okay, well, that's something to keep in mind as well. Bala, your word on this issue before we move on to expense ratios, just how you see the entire industry transitioning to the trail model where there's practically nothing paid up front.
The way it works is, from the time the sales are made, then the expenses starts ticking in. The mutual fund managers will be allowed to charge expenses from the time money comes on board on the basis of the average assets each schemes have got. And the moment the expenses hit the books of accounts, then it has got two components. One is, of course, the management fees, and second is distribution selling commission, which of course keep accruing it, and both the AMC fees will be accrued, and both the AMC fees and distribution commission will be accrued. At the end of the month, whatever is accrued, it's taken to the AMC books of accounts. That will come in the form of management fees, and rest of it from the scheme itself will go to distributors in the form of trial commission. And the way I think the model works is, the trial commission is generally paid out every month and around 10th and 12th of every month, and that the model I think nothing will change, will continue, except there will be a reduction in terms of the payout linking directly to the reduction in the expenses.
Okay, all right. Well, gentlemen, on that note, we will take a break. That's the first part of the big reforms that were ushered in by SEBI. After the break, we come down to expense ratios. Yes, expense ratios have been lowered, but there is a worry already that's building in. Will distributors focus more on smaller funds now? Because that's where expenses are typically higher, or the TERs are typically higher. We put that question to our panel on the other side of the break. Welcome back. You're watching the special edition of Money, Money, Money. We are discussing all the big changes that SEBI ushered in with respect to mutual funds last week. Let's now talk a little more about the cut in expense ratios. So our panel also agrees that on the face of it, it's good news for the investor. But Ashish, my question is this now. Already people are wondering, because the way the slabs work is the smaller the size of the fund, the greater the expense ratio it can charge. So the greater it can incentivize the distribution channels. Is there going to be a propensity, therefore, now to sell more of the smaller funds? Because that, again, is a bit of a risk for the end investor.
I think that can be a minor influence, because, there can be a difference of 0.2%, 0.25% or some such number. And all said and done, people may not want to severely compromise on the performance delivered, because all said and done, intermediaries ultimately are answerable to investors. And if you, just for the sake of few basis points, because now upfront is clearly out of the window. So you have only to choose from higher trail or slightly lower trail or some such thing, and the gap will be few 0.2, 0.25 or something like that. So I think the ability of commissions to influence sales is definitely going to go down. Okay. So I think the regulation is going to be, if the objective was to reduce the influence of commissions, then that objective will be met.
Okay, okay.
I mean, there will always be some or the other outlier, but the incentive to do what you're alluding to is very less.
Okay, fair enough. Same kind of question to close-ended funds. Nimish, if you could take that up, because again, for close-ended funds, it's been clearly capped at, I think, 1.25% for equity funds.
Right.
So what happens to this category of products?
So I think if you look at on the equity side, not many close-ended funds were kind of actually being positioned. It was more from the point of view of having a balance advantage fund or a, more of a debt equity combination as such. So yes, there will be an impact as far as the net sales are concerned, because those schemes are largely kind of required to be positioned more as FD plus kind of return. So to that extent, yes, there will be a reduction in earnings on that particular. But if there is an investor requirement for that kind of a product, I don't think the sales will slow down.
Okay. Feroz, your thoughts on, expense ratios. Now, do you expect any sort of change in the advisory channel and the distribution channel purely because of the cut in ratios, the TERs?
I think a large paradigm shift in how mutual funds are going to be advised. Because the banking channel, which is 30-40% of the total mobilization, was getting significant portions of upfront, if I have to be very transparent. And that would be as high as trails being paid upfront, 2 and 3%. Now, if you have 1% trail on one side and 3% upfront on another, that gap is large enough to influence, and that will go away. So banking channel, to my mind, will start focusing on ULIPs. Private banking segment, which was actually, or the other national distributors, as we call them in our lingo, who were focusing on mutual funds, would start focusing on alternate products to get their commission. So advice delivery will be far cleaner, point one. Practices like upfronts will change the way people will look at long-term assets, right? Thirdly, I think asset management company business will be lesser cluttered, because there is a huge entry barrier now for a small player to come. Today you have 42 asset management companies. 10 MNCs have quit this business in the last 10 years. I think further consolidation is inevitable, and that's good for an investor, because you don't need 42 managers, at least asset management companies. We have 145 equity mutual fund managers. We have 500 open-ended schemes. Of course, the schemes might not compress, but the confusion is going to be lesser. If you have to take your 1.5% penetration of the country's population to whatever globally it is 30, 40, 50%, you will need lesser clutter. I think that will serve the purpose. Coupled with good investor education.
Sure.
Because if this is the rate at which investor education continues, 10,000 crores of rupees is going to be spent at least in the next 10 years. And that's a lot of money.
Okay, so Ashish, your thoughts? I don't know if you agree with that. Will this be the kind of trigger that also sort of brings in consolidation, and also a word on SIPs, because I remember reading the SEBI circular, which clearly says that with respect to commissions, there's a carve-out for SIPs. There, you as the CEO of the mutual fund can still pay some amount of upfront commission. How will SIPs be sold? Because that's the vehicle of choice for a large section of retail.
Yeah, so I 100% agree with what Feroz mentioned about decluttering. Because, I mean, on a lighter note, somebody was telling me that there are some 150 good stocks to buy and some 500 funds available in order for you to buy those 150 stocks in the market. So yeah, decluttering is very important, and I also agree that if you want penetration to increase, you should give fewer and more crisp kind of choices rather than confusing people. I think close-ended funds are out. So that is a good thing, at least from what I understand. Now coming to consolidation and the question on SIPs, I have a slightly different view on consolidation, because I feel that there will be more and more players who would actually come in. The reason being that you take the US experience. For every, in the US, for example, there is PMS, AIF, mutual funds. And typically what happens is that for every $100 worth of investment in a mutual fund, in the US you have nearly $50 worth in alternates.
Okay.
And that is because these asset classes provide you, while it's true that they have more leniency in terms of how they can be priced, but they give you the ability to innovate, take more aggressive positions, come out with different risk-return combinations. For example, long-short funds you can't do in a mutual fund. 10 to 12, 15 stock buy and hold aggressive portfolio you can't do in mutual funds. So many of these things. Coming to SIPs, I think that there is a belief that SIP is the right way to invest. So in order to incentivize right practices, the regulator has said that for SIPs, it is anticipated that for 3 years worth of commission you can actually upfront. So let's say you put, basically what it means is that if you're doing a 2,000 rupee SIP, it's 24,000 per year and 72,000 in 3 years. So for that 72,000 rupees, some commission can be paid upfront.
Some, not all, but some.
Yeah, some part of it, not the whole TER or something like that. There can be some commission.
Okay, fair enough. We are coming down to last thoughts now, and I think the big question also from an equity market point of view is that equity market anyway has its own issues, and now the fact that the entire mutual fund distribution model is going to undergo a change. So Bala, this big question to you, I mean, how long will the transition take? And again, does this mean a drop in mutual fund inflows, at least in the immediate term?
The funds are being sold on the basis of various parameters. One, of course, the fund house acceptance, both for the distributors as well as for the investors. And second is the product suitability. And third, of course, what is the period for which is coming. And then finally is of course, the expenses. And of course, there will be some element of selling will happen on the basis of how much you are getting rewarded and how much is the expense you are charging it. At the end of the day, one cannot move away from the fact that the selection methodology remains constant irrespective of whatever the expenses are there. Therefore, to some extent, the same policy will continue. At the same time, there are many fund houses, even on the smaller size in nature. And
So I get that point, Bala. What I'm trying to understand is that, I mean, we've discussed the fallout of the expense ratio cuts, but on the market as a whole, with respect to the way in which flows have anyway been coming down, are you expecting a bigger drop in the near future?
Currently, is one, of course, the decision of the board has been is out and is out in the public domain. One has to wait for detailed note to come from SEBI, clearly giving the time of implementation. Of course, the system also need to get adjusted. Therefore, I'm sure they will give some kind of time for the industry to get adjusted. Therefore, this time, sufficient time will be given for implementation of this. As far as the inflow is concerned, it's of course linked to the market sentiment. As to the month of August, we have seen some bit of reduction in the flows in equity mutual fund schemes, and even September also remain more or less the same. I think ultimately the flows into the equity mutual funds, both in fixed income and equity, would depend upon the conviction of participating in the capital market through the mutual funds, and given the fact that investments are made for long term. At the same time, the market volatility would also drive the flows and also the recommendation both from the AMCs as for the distributions as well as from the investors' mindset.
Well, volatility is perhaps the one word that sums all of this up. There are a lot of changes happening, of course, within the market and outside within the mutual fund sector as well. Gentlemen, thank you very much for your time today. Thanks for joining in. Let's see how these big changes roll out over the next couple of months. That's it on this edition of Money, Money, Money. Thank you for joining us.